Buy low, sell high. It's perhaps the most popular stock market cliche there is. Buy stocks when they're at a low price and sell them for more in the future. But how do we know a low price when we see it? For that, we turn to another popular cliche: buy the dip. It's the strategy of purchasing stocks during or after a market decline with the expectation that prices will eventually regain what they lost, and then some. It's like waiting for a sale on that new pair of sunglasses you wanted. You thought about buying them at $100 yesterday, and now that they're $80, they look even better. But instead of sunglasses, maybe it's your favorite stock or index fund. Buying the dip means your intention is to avoid paying top dollar for stocks so you can give yourself more room for upside. Unfortunately though, the unpredictability of the markets means it's not always that simple. So here are 3 reasons why buying the dip might not be the right move to make. Reason number 1, you don't know when the dip will be. Timing the market can be tough to do, which makes it difficult to know when the dip is coming. And the problem with that is what you're missing out on as you wait for that dip. For example, starting in March 2009, the S&P 500 entered into its longest bull market ever. The index gained about 500% before the run finally came to an end in 2020 at the start of the COVID-19 pandemic. But even when it hit its bottom, it only fell to the level it had been at in 2017 and was still 300% above where it was in 2009. Historically, research shows that lump sum investing, the strategy of putting a certain amount of money into the markets all at once, generally comes out ahead of waiting to buy the dip. Ben Felix of PWL Capital found that lump sum investing outperformed waiting for a 10% dip 57% of the time, and beat waiting for a 20% dip 68% of the time. If you had been on the sidelines since that rally began, waiting for an opportunity to buy the dip on something like an S&P 500 index fund, you missed out on almost a decade of dividends and capital gains. So while your goal for buying the dip might be to accelerate the growth of your portfolio, keeping cash on the sidelines waiting for a dip, especially over longer periods of time, is essentially like having a more conservative asset allocation. It represents an opportunity cost that could limit your portfolio's growth potential over the long term. And meeting your financial goals can become even harder if your plan was to sell part of your portfolio on the expectation of a market decline to later buy the dip. In that instance, you'd have to be right twice, which even professional traders struggle with. Reason number 2, you don't know if you're buying at or near the bottom. Let's go back to the S&P 500 crash that began in early 2020. The index entered a correction, or a drop of 10% or more from the recent high, in the final week of February. If you had been waiting for a chance to buy, maybe you thought that was it, but it wasn't the bottom, not even close. That wouldn't come for another month, meaning anyone that bought the S&P 500 on the day it entered a correction would have lost about 25% of their investment in a matter of weeks. Or take the market turmoil we recently saw with the tariff war that's embroiled the world. The S&P 500 fell more than 12% from April 2nd to the 8th, but quickly rebounded with a 9% gain the next day. We can't know when the dip is coming, and we also can't know how deep it will be or when it will recover. So it's a good idea for investors to consider their risk tolerance and their investment timeline when they're thinking about buying stocks. Are you willing to ride the dip further down? Do you have the time to wait for the anticipated recovery? Important questions to ask yourself when you see falling stock prices. Reason number 3, the dip is a sign of something bigger. So far, we've discussed someone buying the dip on an S&P 500 index fund. But let's say you're less diversified. All your money is in one company and shares are falling. An important question to ask yourself before buying the dip on this stock should be, why is there a dip in the first place? Take the current situation around tariffs, for example. You should consider whether the drop in the share price is directly related to a fundamental impact on its business model that could warrant a lower valuation, or if it's simply caught up in a broad market decline that could represent a buying opportunity. You would have to do your homework on what you believe is a fair price for the stock both today and in the future to be able to jump on opportunities to buy the dip. In summary, trading stocks carries risks, but also offers potential for great reward. So next time you think about waiting to buy the dip, consider these 3 risks: the opportunity cost of waiting for the dip, the risk of not knowing how deep the dip will go, and that the dip might be a sign of something bigger. As always, it's wise for investors to consider their investing timeline and risk tolerance before making any decisions. Check out the Learning Center for more educational content so you can make confident investing decisions instead of blindly following the old market cliches. Thanks for watching.
Have more questions? Check out the links to the right and in the description below.